Gold was calm. Silver was steady. Then, in a matter of seconds, both exploded higher. Prices surged so fast that trading screens struggled to keep up. Gold futures leaped. Silver followed with even more force. Financial headlines flashed across terminals. Commentators rushed to explain what they were seeing. For a brief moment, it looked like the beginning of a powerful breakout, another leg higher in the long story of precious metals. And then, just as quickly, it reversed. The spike faded. Momentum stalled. Within minutes, gold gave back its gains. Silver dropped even harder. What looked like strength turned into sharp selling. Traders who chased a move were suddenly trapped. Volatility replaced confidence. The move up and the move down happened so quickly that many retail investors only saw the aftermath. So what just happened? The trigger was a policy shock from the Federal Reserve. Not a dramatic emergency meeting. Not a surprise rate hike. But something more subtle and more powerful. A shift in tone. A change in forward guidance. A signal about the future path of interest rates and liquidity. In modern markets, that is enough. Gold and silver are not just commodities. They are monetary assets. Their prices are deeply connected to expectations about inflation, real interest rates, currency strength, and central bank credibility. When the Fed speaks, markets do not simply listen. They recalculate. The first reaction suggested one interpretation. Traders initially read the signal as supportive for metals. Perhaps inflation risks remained elevated. Perhaps rate cuts were closer than expected. Perhaps liquidity conditions might ease. Algorithms responded in milliseconds. Futures contracts were bought aggressively. Short positions were covered. Momentum traders jumped in. Prices shot higher. But then something shifted. As analysts parsed the language more carefully, a different interpretation emerged. The message may have been less dovish than expected. Real rates might stay higher for longer. The US dollar could strengthen. Liquidity might remain tighter than markets hoped. In that moment, expectations flipped. And when expectations flip in a leveraged system, prices do not adjust slowly. They snap. This was not random volatility. It was a collision between narrative and reality. Between what markets hoped to hear and what the Fed actually signaled. The speed of the reversal tells us something important. Today's financial system is hypersensitive. It is wired for instant reaction. Trading desks are dominated by algorithmic models that scan keywords, compare projections, and execute orders without hesitation. Liquidity is deep until it suddenly isn't. When everyone tries to reposition at once, price gaps appear. Gold and silver sit at the center of this sensitivity because they represent a form of monetary insurance. When trust in policy weakens, they rise. When confidence in central bank control strengthens, they struggle. The spike and crash revealed something deeper than confusion. It exposed how fragile conviction has become. Investors are not operating with long-term certainty. They are navigating shifting signals in an environment defined by inflation, uncertainty, geopolitical tension, and heavy global debt loads. This is why the move matters. Rapid reversals like this are symptoms of a system stretched between competing forces: inflation versus growth, tightening versus easing, stability versus fragility. Each Fed communication becomes a stress test. Each market reaction becomes a window into hidden pressure beneath the surface. And beneath that surface lies the true story, not just of gold and silver, but of liquidity, leverage, and the structure of modern money. Because if a few sentences from the Federal Reserve can send precious metals soaring and collapsing within minutes, the real question is not about the spike itself. The real question is what, exactly, the market heard and why that signal broke the normal rules of behavior. The real question is what the market heard and why that signal broke the normal rules of behavior. To understand that, we need to step inside how markets process information. Prices do not move on news alone. They move on the gap between expectation and reality. Before the Fed even speaks, traders have already built models around what they think will be said. Interest rate futures, bond yields, currency positions, these all reflect a consensus view about the path forward. In this case, the focus was on rate cuts and liquidity conditions. Investors had priced in a certain pace of easing. Some expected a softer tone on inflation. Others believed the economy was slowing enough to justify support. That collective belief was embedded in asset prices long before the announcement. When the Federal Reserve released its updated guidance, the initial read appeared supportive for metals. Perhaps the language suggested flexibility. Perhaps it acknowledged downside risks. In those first seconds, algorithms interpreted the text as dovish. Gold and silver surged because lower expected real yields typically benefit non-yielding assets. Under normal conditions, the relationship is straightforward. When real interest rates fall, gold tends to rise. When the US dollar weakens, metals often strengthen. Silver, with both monetary and industrial characteristics, usually amplifies gold's move. This framework has held for decades because it reflects opportunity cost. If safe government bonds pay less in real terms, holding gold becomes more attractive. But this time, something unusual happened. As traders digested the details, plots, inflation projections, commentary in a press conference, the narrative shifted. The message may not have been as supportive as first assumed. The rate path could remain restrictive longer than markets expected. Inflation persistence may have been emphasized more than growth risks. The probability of rapid cuts may have declined. In a system dominated by leverage, that shift matters instantly. Gold spike suggested that traders initially believed policy would tilt toward easing. The crash implied a rapid reassessment toward tighter conditions. That reversal was not emotional. It was mechanical. Algorithms recalculated yield expectations. Treasury yields ticked higher. The dollar strengthened. Futures positions flipped from net buying to forced selling. And because modern markets are tightly interconnected, the reaction cascaded. When yields rise unexpectedly, large funds must rebalance. When volatility spikes, margin requirements increase. When margin requirements increase, leveraged positions are reduced. Selling accelerates not because traders change their philosophy, but because the system demands adjustment. This is where the normal rulebook begins to crack. In earlier decades, price discovery was slower. Investors had time to interpret speeches. Now, language is parsed in milliseconds. Keywords are weighted against historical patterns. Entire portfolios are adjusted before most people finish reading the headline. That speed creates liquidity gaps. In calm moments, markets appear deep and stable. In shock moments, bids disappear. Prices jump between levels. What looks like chaos is often a chain reaction of programmed responses. The big signal, then, is not simply that gold spiked and crashed. It is that the system revealed its fragility. Conviction is thin. Positioning is crowded. Expectations are tightly clustered around specific policy paths. When those paths shift even slightly, volatility explodes. This matters because gold and silver are often seen as long-term anchors of stability. If even these assets are subject to violent whiplash from subtle policy adjustments, it tells us something about the broader financial structure. Markets are no longer just reacting to economic reality. They are reacting to anticipated reactions to anticipated policy. It is a hall of mirrors built on leverage and speed. And when price discovery becomes this fragile, attention naturally shifts beyond trading desks. Because if signals from central banks can trigger such instability in financial instruments, we have to ask a deeper question. What happens when stress moves from paper markets into the physical world of supply, production, and geopolitical power? What happens when stress moves from paper markets into the physical world of supply, production, and geopolitical power? To answer that, we have to step away from trading screens and look at the real metal itself. Gold and silver are not just symbols of value. They are mined from the ground, transported across borders, refined in specialized facilities, and stored in vaults under strict security. Behind every futures contract is a supply chain that stretches across continents. Behind every price spike is a network of miners, refiners, logistics firms, and central banks. Start with mining. Gold production is geographically concentrated. A significant share comes from countries with complex political and regulatory environments. Silver production is often tied to base metal mining, meaning its supply depends not only on silver demand, but also on copper, lead, and zinc cycles. That alone creates structural constraints. Now, consider refining. Raw ore is not investment-grade metal. It must be processed in advanced refineries, many of which are located in Asia. China plays a major role not only in refining capacity, but also in consuming and stockpiling precious metals. Russia remains a significant gold producer, and geopolitical tensions can affect how its supply flows into global markets. Western financial centers rely on these global flows. London and New York may dominate pricing, but they depend on physical metal moving smoothly across borders. When geopolitical friction rises, sanctions, trade restrictions, transport disruptions, those flows become less predictable. This is where the real tension builds. Financial markets trade enormous volumes of paper gold and paper silver, futures contracts, options, exchange-traded products. These instruments represent claims on metal. In many cases, the total paper claims far exceed the amount of physical metal available for immediate delivery. Under normal conditions, this works because most contracts are settled in cash or rolled forward. Very few participants demand physical delivery. The system functions on trust and netting. It is efficient, liquid, and scalable. But efficiency can mask fragility. When volatility spikes, margin calls increase. Traders must post additional collateral. If liquidity tightens at the same time because of rising rates or dollar strength meeting, those requirements becomes harder. Positions are reduced. Contracts are closed. Prices swing sharply. Now imagine that this financial stress coincides with physical constraints, shipping delays, refinery bottlenecks, sanction-related rerouting. Suddenly, the gap between paper claims and physical availability matters more. This is not a prediction of shortage. It is a structural observation. The system is layered. At the top, highly leveraged derivatives trade at lightning speed. Beneath that, slower-moving physical supply chains operate under geopolitical realities. When monetary policy shifts like the shock we just witnessed, it does not only reprice expectations, it pressures both layers simultaneously. Tighter liquidity stresses leveraged traders. Stronger currencies affect commodity pricing. Geopolitical tensions influence supply routes. The question then becomes one of leverage. Who truly holds power in such an environment? The trader operating algorithms in Chicago, the central banker adjusting forward guidance, or the mining company controlling output in politically sensitive regions. Power in commodity markets is not static. It shifts depending on liquidity conditions and geopolitical stability. When capital is abundant and rates are low, financial players dominate price action. When liquidity tightens and political risk rises, control slowly migrates toward those who control physical supply. This is the deeper battle unfolding beneath the volatility. The spike and crash in gold and silver were not isolated events. They were surface expressions of a system balancing between financial abstraction and physical reality, between leveraged bets and tangible resources. And when those two layers begin to pull in different directions, the implications extend beyond metals, because gold and silver sit at the intersection of commodities and currencies. When supply chains strain and liquidity tightens at the same time, the impact does not stop at price charts. It flows into exchange rates, bond markets, and the global monetary order itself. And when supply chains strain and liquidity tightens at the same time, the impact does not stop at price charts. It flows directly into currencies. Gold has always carried a monetary shadow. It does not pay interest. It does not produce cash flow. Its value rests largely on trust or, more precisely, on distrust. When confidence in paper currency weakens, gold often strengthens. It acts as a hedge against debasement, against inflation that erodes purchasing power over time. Silver occupies a dual role. It shares gold's monetary history, yet it is also deeply industrial. It moves with economic cycles as much as with currency fears. That dual nature makes silver more volatile, especially during moments of policy uncertainty. To understand the recent spike and crash, we need to follow a simple chain reaction. Rate expectations move first. When the Federal Reserve signals tighter policy or fewer rate cuts, Treasury yields typically rise. Higher yields attract capital. Global investors seeking return shift money into dollar-denominated assets. As capital flows in, the U.S. dollar strengthens. A stronger dollar creates pressure across commodity markets because most commodities are priced in dollars. When the dollar rises, gold and silver become more expensive in other currencies. Demand can soften at the margin. Prices adjust downward. The chain looks like this. Rate expectations gives treasury yields, gives dollar strength, gives commodity pricing, gives global liquidity. But the story does not end there. When the dollar strengthens sharply, emerging market economies often feel strain. Many carry debt denominated in dollars. As the dollar rises, their repayment burden increases. Capital may flow out of those economies back into U.S. assets. Financial conditions tighten globally, not just domestically. Banks also feel the pressure. Higher yields reduce the market value of existing bonds on their balance sheets. We saw in recent years how rapid rate increases exposed vulnerabilities in parts of the banking system. Liquidity facilities were introduced to stabilize conditions. Asset prices recovered as central banks injected support. Those interventions matter because they reveal the balancing act policymakers face. Tighten too much, and financial stability risks emerge. Ease too quickly, and inflation expectations can reignite. Gold volatility reflects that tension. When markets believe central banks have inflation under control, real yields rise and metals struggle. When markets doubt that control, when they suspect policy may pivot under stress, gold often regains strength. The recent spike and reversal suggest uncertainty about which path lies ahead. Can central banks maintain restrictive policy long enough to anchor inflation without triggering deeper financial cracks? Or will economic and banking pressures force a softer stance? This is no longer simply a commodity story. It is a story about confidence in currency regimes, about whether paper systems backed by policy credibility can navigate a world of high debt and shifting geopolitics. And when trust becomes the central variable, the question naturally turns from macro systems to personal impact, how these shifts filter down to households, savings, and everyday financial decisions. And when trust becomes the central variable, the story inevitably moves closer to home. Most people do not trade gold futures. They are not monitoring treasury yields minute by minute, but they do feel the effects of inflation, rising borrowing costs, and shifting economic confidence. When gold and silver swing violently within minutes, it signals something larger about the environment surrounding savings and purchasing power. Volatility in precious metals reflects uncertainty about the rules of the system itself. Are interest rates staying high? Will inflation return? Is the banking system stable? These are not abstract questions. They influence mortgage rates, job markets, retirement accounts, and business investment. To navigate this environment calmly, it helps to rely on structured mental models rather than headline. The first is the liquidity-first model. In periods of stress, markets sell what they can, not just what they want to. If investors face margin calls or redemption requests, they may liquidate gold or silver even if they believe in a long-term case. This explains why metals sometimes fall during broader market sell-offs. It is not always about changing conviction. It is about access to cash. The second is the expectation gap model. Prices move on surprises, not unknown information. If everyone expects inflation to cool, and it does, markets barely react. If inflation surprises to the upside, assets reprice quickly. The same applies to central bank communication. The gap between what was expected and what was delivered drives volatility. The third is the leverage amplifier model. Modern financial systems carry high levels of debt, sovereign, corporate, and household. Leverage magnifies both gains and losses. When policy signals shift, leveraged positions must adjust rapidly. That adjustment creates sharp price swings, even if the underlying economic change appears small. The fourth is the currency confidence model. Gold and, to a lesser degree, silver act as mirrors of trust. When confidence in central bank control weakens, metals often rise. When policy credibility strengthens and real yields increase, metals tend to retreat. The movement is not random. It reflects changing belief about the future value of money. Using these models, Volatility becomes less mysterious. Instead of reacting emotionally to a spike or crash, we can ask structured questions. Is this move driven by liquidity stress? By a surprise in inflation data? By a shift in real interest rates? By sudden dollar strength? Each question narrows the explanation. This framework does not eliminate uncertainty, but it reduces confusion. It turns chaotic price action into signals that can be interpreted logically, because beneath every sharp move lies a deeper process. And understanding that process allows individuals to observe rather than panic, which leads to the final and most important question. If these forces continue to build tight liquidity, heavy leverage, fragile confidence, what are the realistic paths forward from here? Which leads to the final and most important question. If these forces continue to build tight liquidity, heavy leverage, fragile confidence, what are the realistic paths forward from here? There are three broad scenarios worth considering. None are guaranteed. All depend on how policy, inflation, and global stability interact over time. Scenario 1 is controlled tightening. In this path, the Federal Reserve maintains credibility. Inflation continues to moderate gradually. Economic growth slows but avoids a deep contraction. Real interest rates remain positive. The dollar stays relatively firm as global capital continues flowing toward U.S. assets. Under these conditions, gold and silver may remain volatile but largely range-bound. Spikes and pullbacks would occur around data releases and policy signals, but no sustained breakout develops. Investors treat metals as insurance rather than as a primary growth asset. The system absorbs higher rates without breaking. This outcome would signal that central banks can manage inflation without destabilizing the broader financial structure. It represents balance tight enough to control prices, flexible enough to avoid crisis. Scenario 2 is policy pivot under pressure. Here, economic weakness becomes more visible. Labor markets soften. Credit conditions tighten sharply. Perhaps segments of the banking system show renewed strain. In response, policymakers begin easing sooner or more aggressively than expected. Real yields fall. The dollar weakens. Liquidity improves. In this environment, gold and silver could regain structural momentum, not necessarily in a straight line, but with a stronger underlying bid. The narrative would shift from inflation control to economic stabilization. Metals would benefit from lower opportunity cost and renewed concerns about long-term currency dilution. This path would not imply collapse. It would reflect a system that prioritizes growth support over restrictive discipline. But it could also reopen questions about inflation persistence. Scenario 3 is a liquidity shock event. This is the most unpredictable path. It could emerge from sovereign debt stress, a sharp repricing in bond markets, or an escalation in geopolitical tensions. It could begin in a regional banking system or in an over-leveraged sector of the financial markets. In such a case, volatility would not remain contained. Safe haven flows could accelerate rapidly. Gold might surge as capital seeks stability. Silver could move sharply in either direction, depending on whether the shock is inflationary or deflationary in its early stages. Liquidity would become the central variable again. Central banks might be forced into emergency responses. Markets would reprice risk across multiple asset classes simultaneously. It is important to stress that these scenarios are frameworks, not forecasts. Markets are adaptive systems. They respond to feedback loops. A tightening cycle can reveal stress, prompting easing. Easing can reignite inflation, prompting renewed tightening. Confidence can shift gradually or abruptly. The recent spike and crash in gold and silver remind us how sensitive the system has become. A few sentences from policymakers were enough to trigger violent moves in assets that are supposed to represent stability. That is the real signal. If metals can react this sharply to one communication shift, what happens when the next true stress point emerges? What if pressure builds, not just in futures markets, but in sovereign debt auctions, in regional banks, in currency pegs, in geopolitical flashpoints? Those fault lines already exist. They are not always visible, but they are measurable. In our next analysis, we will examine where the most likely pressure crack may form within the global financial system, why that crack could matter far more than a single volatile trading session. Because the spike was a warning, the reversal was a reminder. And the deeper story is still unfolding.